probabilities associated with the potential outcomes and referred to this as unmeasurable uncertainty or true uncertainty. Today we refer to it as Knightian uncertainty. 5. An example given by Knight should help us understand Knight's distinction between risk and uncertainty. Consider an urn that includes red and black balls. Two individuals are asked to draw a ball from the urn. Because the first individual has no information about the number of red and number of black balls in the urn, she might assume that there is an equal probability of drawing a ball of either color. Unlike the first individual, the second individual has information that the urn contains 3 red balls for each black ball. Because of this information, the second individual knows that for every 4 balls in the urn, 3 are red and, therefore, the probability of drawing a red ball is 75%, and the probability of drawing a black ball is 25%. According to Knight, the second individual faces risk while the first individual faces uncertainty. We can cast this illustration in terms of an investment decision. Consider an investor evaluating 2 companies for possible inclusion in a portfolio. The first is a publicly traded company founded in 1950 whose financial information is publicly available since its inception. The second company is a high-technology startup that has not generated any revenue. In evaluating the prospects of the 2 companies in terms of future price performance, the investor might view the decision for the publicly traded company in terms of risk and the private company in terms of uncertainty. There is a long-running debate amongst economists about the relevance of the distinction between risk and uncertainty in decision-making. Some economists argue that the 2 concepts are the same while others argue that the distinction is crucial. For asset managers, there is strong evidence that the distinction is important in decision-making. This evidence comes from the global financial crisis of 2008-2009. There are several. 5. A similar distinction between risk and uncertainty was made by John Maynard Keynes in 1921. He argued that there is risk that can be calculated and another sort of risk that he labeled irreducible uncertainty. Keynes recognized that there are decisions where risks cannot be computed because attempting to do so would require relying on assumptions about the future that have no basis in probability theory. See John M. Keynes' Treatise on Probability, New York, Macmillan. To me, because as we know, there are known knowns, there are things. The bottom line: finance blends together economics, psychology, accounting, statistics, applied mathematics, data science, operations research, and probability theory to make decisions that involve future outcomes. We often characterize finance as comprising 3 related areas: capital markets and capital market theory, financial management, and investment management. Capital markets and capital market theory focus on the financial system. That includes markets, intermediaries, and regulators. Financial management focuses on the decision-making of a business enterprise, which includes decisions related to investing in long-lived assets and financing these investments. Investment management deals with managing the investments of individuals and institutions. In making financial decisions, financial managers and investors should understand the difference between risk and uncertainty. In making investment decisions, there are different approaches in selecting companies based on the view that it is not just the financial performance of a company but other factors that involve society and the environment. Such approaches include environmental, society, and governance investing, socially responsible investing, and impact investing. Practice questions. 1. What distinguishes investment management from financial management? 2. What is the role of a discount rate in decision-making? 3. What is the responsibility of the investment manager with respect to the investment portfolio? 4. Distinguish between capital budgeting and capital structure. 5. What distinguishes current assets from other assets of a company? 6. If a market is price efficient, A. Can an investor beat the market? B. Which type of portfolio management, active or passive, is best? 7. List the general steps in the risk management of a company. 8. What is enterprise risk management? 9. List the 5 activities of an investment manager. 10. What are some of the factors considered in ESG investing? Finance is a term that encompasses a broad range of activities related to the management of money